Hello again and welcome to this next equity masterclass, and this one is on company analysis, past and present. Now it's really important that you see this module in the context of being one of three modules and what it is trying to achieve in the overall curriculum. So this module has been brought in for the 2024 curriculum. It has not been in the curriculum prior to that, although similar things were in there, but it's been extensively rewritten. And I think it's important to understand what its role is. Its role is to sit as one of three linked modules, which are all about focusing on the job of an analyst and what an analyst needs to do when producing an analyst's report on a company. Now, that analyst might be someone who works for an investment bank, might be someone who's providing support for the buy side, i.e. investment firms, or it might be an independent analyst who produces reports and is maybe well respected for being an expert on a particular sector or even a particular company, and people pay for those research reports. So the analyst is expected to be, as the name implies, someone who can analyse the information, but also is a sort of respected, potentially independent person looking at the company from the outside in. Okay, now I mentioned this is one of three readings, and indeed there's three modules that sit together, and this is the first of those three. But all of them are really pulling together the skills from all around the Level 1 curriculum and placing them together in one place. Really, this sort of this module and the other two, they kind of sit as maybe the last things that you should read, having gone through financial statement analysis, economics, maybe a bit of quants, and all of the equity. So just consider sort of the place of these modules and think, have you done everything that fully supports you in the lead into this? You could also say that some of the corporate issuers work on working capital ratios and things like that are also relevant. So don't feel bad if you want to park this and come back to it once you've done all of those other sections of the curriculum. But anyway, it sits in this trio, and we've got here a nice little pyramid, and we are at the bottom of this pyramid. So it's basically taking the company and trying to analyse the things that drive these five very important things. Then as we move through onto the next module, we'll be looking outside of the company and thinking about the industry it works in and the how to analyse the competitive environment. And then we move on to the top one, which is forecasting. Now, I would say, hand on heart, there is nothing new in these three readings that has not been covered already in detail elsewhere in the curriculum. It is an application and context section of the curriculum, and it's showing how all of these skills can be used to draw conclusions, forecast, inferences about companies that we are looking at as an analyst. So we've got these 5 bullet points at the bottom here, which are picking up 2 very important points from the P&L to begin with. So the top line, the revenue, and the operating profit or earnings before interest and tax. Very important. I know there's lots of different subtotals that you can do for profit, but operating profit has got to be a key one, because after that comes interest, which is to do with financing, and tax, which is largely out of our hands. So operating profit is very key to understand. So we've got that from the P&L, and then we've got some things going on in the balance sheet. So we've got working capital and capital investment. Why is working capital so important? Because it links directly to cash flow. So every extra pound, euro, dollar that we've got in receivables is a pound, euro, dollar that is not in our bank account. So there's the understanding the working capital cycle is very important in terms of understanding a company's cash position. And then, of course, we've got the capital structure decision, which is very important for a company as well. So that's what we're trying to achieve out of this. And we will go through those 5 bullets, those 5 bullet points in turn, and look at what we perhaps already know or will be coming to know if you haven't yet studied various other parts of the curriculum, but just pulling it all together and thinking, how might an analyst use this information? So if we start at the top of the P&L, the top line, we've got revenue, and we can take 2 approaches to forecasting what a company's revenue should be, or indeed understanding what it has been in the past. We could also do a composite, a combination of the 2, but it's important to know the 2 primary approaches. One is to do what's called top-down. So if you were to favour the top-down analysis, you would start by looking at the market, and you'd think, what is this industry? What is the size of the market? And then from that, what is this company's market share? And then if you understand those things, that can lead you through to understanding the revenue potential. Now, obviously, the market itself may be driven by what's going on in the economy. So understanding the GDP, gross domestic product, the size of the economy is important. Is this a growing market, shrinking market, and what is happening to our share within the market? So if you were given some information on the market size and that it's likely to grow at the rate of GDP growth, which you're given, and that we are a particular slice or size share of the market, we would be able to combine that information without too much difficulty to say what we think our revenue should be. Now, bottom up, as the name implies, just starts from a completely different angle and says, no, let's look at the company itself and forecast volumes and prices for the company. And that drives our forecast of revenues. Okay. And for that, we would be looking in detail and be thinking, what does the company do? What's their product line? What's each segment that they may operate in? Companies often report things by products or by companies' geographical information. So a lot of this information will be made available to us. Now, when we're talking about prices, it's important to think about how prices might be driven by decisions that the company makes versus how much comes from what the market imposes. So we talk about pricing power and trying to understand a company's pricing power. Now, having pricing power is a good thing for the company because it means that you could put the price up without adversely affecting volume too much. Now, we can't break the basic laws of economics here, but if we have a company with a very strong brand and features, high quality, something that people really want, the market can take a bit of a price rise without us dropping too much in volume. Indeed, possibly without overall dropping in volume at all, if it is a very highly valued product. So think about the high tech or the consumer tech, the wearables, the Apple Watches and things like that, how it may be possible when a product's quite new to have a high price and maintain that and not necessarily lose in volume. So what this does is it brings in what you've seen elsewhere. Now, I'll be saying this quite a lot. Economics. So understanding that in perfect competition, we are generally price takers, aren't we? If we're operating as a company in perfect competition, we cannot put our prices up because the buyers will switch to other products because all products are identical in perfect competition. So what companies may well want to do is try and move themselves towards having more monopoly features. And that can be done through investment in branding and technology. So making your product different, desirable, and putting up barriers to other people copying the product. Okay. Also consider the position in the market as well. So if you are a low-cost producer, for a start, it might confuse customers if you start putting the prices up, but also that may be how you maintain your market share is by keeping those prices low. So we do have to understand the business very well as an analyst if we can start making these predictions as to how things are going to change and understanding the drivers of revenue. Okay, so let us move down now, down the income statement, down the P&L to profitability. Now, revenue's all very well, but you've got to convert it into profits, haven't you? So we've got a couple of little formulae here. They're not really, I wouldn't say they're formulae as such, they're more relationships that you need to understand. Now, accountants sometimes talk in terms of a thing called contribution. And contribution, bit of a mouthful, it's actually contribution towards fixed costs and profit. Contribution is the variable element of profit. So if volume doubles, contribution doubles. It basically takes all of your revenue as being like a set amount per unit. So P there is the price per unit. And VC are the variable costs per unit. Okay, so if you've got your selling price per unit less your variable cost per unit, and they can be variable costs from anywhere in the P&L. So they can be within cost of sales, or they can be other costs. It can be marketing costs, distribution costs. But if you can work out all of your variable costs per unit, then what you've got in the little brackets that I've put a little square around is your contribution per unit. So if you multiply that up by the number of units that you sell, that gives you your contribution in total. So the variable element of profit. We can then take off all of the fixed costs, so FC for fixed costs. We can take off all of the business's fixed costs, and that gives you your operating profit. Now note, this is all before interest and before tax, so everything is about the business operations. Now, that's quite a nice way of looking at a business, but it's not something you'll ever see disclosed on the face of a set of accounts. Companies don't split their costs down into variable and fixed costs. They're not headings that you see. So instead, it's the job of the analyst to look at the costs and think, well, what elements of these would be variable, like a per unit cost, and which would be fixed? So they wouldn't halve when output halves, and vice versa. So that's quite a useful little relationship for doing what we could call a back of envelope, or a rough estimate, guesstimate even, of what profits could be at different levels of volume. So that's quite useful. The other thing, the second bullet point there, the degree of operating leverage, which I've always been a huge fan of this as a measure. It's picking up on the presence of fixed costs. Often overlooked, but I think these came into sharp relief when COVID hit, and suddenly businesses, their volume sales went right down, but their fixed costs were still there. And that's the problem with fixed costs. They don't go away, and they act as a multiplying effect. So when your sales go up or down a bit, your operating profit goes up or down a bit more. And if you've got a business, take it to its extreme, that is entirely fixed costs, then you'll see a big swing in operating profit, won't you, when the revenue goes down or the revenue or sales goes up, because basically your costs all stay where they are. So the bigger the degree of operating leverage, the more volatile the profits are. So high degree of operating leverage means more volatile operating profits, which means it's a riskier company. And this we're going to link in with the financing discussion later on. Okay. Now, risk can be good in good times, but it can be disastrous in bad times. So it's important that we think, what do the fixed costs do? And, a lot of the hotels and things like that, they had a lot of fixed costs, didn't they? But volumes went right down. So sometimes businesses will try and convert their fixed costs to variable costs just to remove some of that volatility. Okay, so let's put this into context. And here's an example, which is a simplified version of one in the CFA Institute materials here, but just tried to trim it down so that you can see it without all the extra detail. Okay, so we've got Ribbon Energy Limited, so producing oil by the looks of things. So we've got some guidance for analysts. So it is forecast figures for the next 12 months. So you can see there the sales volume, more than thousands of barrels, costs per barrel, that's the cost of getting the oil up out of the ground or from under the sea or wherever it is. And then we've got a couple of other costs, which don't really look like they are linked to volume at all. They just look like they're costs that are there in the business. So it would look to me like those production costs per barrel, well, the clue's in the title, will be variable costs, and these two are likely to be fixed costs. So given an assumed oil price that we can see there, you are asked to calculate the contribution margin per barrel. Right, a margin implies we're relating it to sales, doesn't it? So per barrel, what is the contribution? And we could express it as a percentage of sales. Then what should our operating profit be at that level of output? And what is the degree of operating leverage? By looking at what would happen to those numbers if volumes were 5% lower. So you would have to be given that kind of indication. So what would the degree of operating leverage be if there was a change? Okay, we're not working it out from first principles here. So I would suggest that you pause me for a little bit and just have a go. It's not complicated. It's one of these things that you just have to have done it once, and then you do it in the exam, or you see it in the exam and you know what it is you are expected to do. So I will continue that. I will assume that when you're ready to look at the solutions, you press play again. Okay, so our first question, contribution per barrel is just your selling price less your variable costs. If your answers were all as percentages, you could give that as a percentage of the selling price as well, if it was asking for a percentage. For operating profit, we know our volume and we know our selling price less our variable costs. So that gives us our contribution. And then our fixed costs get taken off, and that gives us our predicted forecast operating profit. And then our question was, what's the degree of operating leverage? Well, what would happen if volumes were 5% lower? So everything that's variable would be dragged down by that 5%. So that's what we've done in the adjustment there. But the fixed costs stay where they are. Okay, so that gives us a drop. When you work out the percentage change, that gives us a drop of 6.3%. So our degree of operating leverage there is showing us that for a 5% drop in volume, we've got a 6.3% drop in operating profit, which I don't think is jumping out at me as a very high level of operating leverage, but it is showing the impact of having those fixed costs and that your profit drops by more than your sales volume did. So we finish off this section by just checking that we understand exactly what they mean when they talk about profitability. Just double check, which margin are you talking about? The focus of the module is about operating profit, but of course gross profit's important as well, GP, and sometimes that can be used as a proxy for contribution because most of the costs of sales would be variable most of the time. EBITDA, you may have come across that. EBITDA is not something that appears as a natural subtotal on the income statement or P&L, but it's something that's used quite a lot by analysts, and we add back depreciation and amortization to the operating profit. And that can just remove some of the management choices that are inherent within deciding what depreciation policies will be, for example. So it's close to operating profit, but it's a little bit more of a cash flow figure. And it is, as I say, it is quite commonly used versus just your plain operating profit as we've been seeing. Also be aware that the major driver for profitability will be output. So volume's the major driver, partly because, you double your output, and or you double your volume sold and you double your contribution, and that flows through obviously to your bottom line. But it's not just that. You've also got economies of scale, and this might link in with what you've seen already in economics. So economies of scale is you're doing more of the same thing, so you get more efficient at it, and you can get things like, volume discounts. The inputs become cheaper per unit, not just that you're doing more. So declining costs as the volume grows. And also you're just better at it, aren't you? You understand how to schedule manufacturing and the machines and stuff better, and you've got through the learning curve. So I know economists will have strict definitions of these, but as you do more of something, as you run your business, you get better at it. But economies of scope, it's not quite the same. Economies of scope is you're doing more things, just not more of the same thing. So you've maybe got different production lines running. You can now share back office functions like IT and admin and spread them out. So your economies of scope are, as it says, a decline in costs shared across different product lines, which is a bit of a different thing, not just economies of scale. Now, the final point that I think is really, really crucial for businesses and often forgotten is this link between the degree of operating leverage. Remember, we said lots of that equals risk, volatile profits when volume changes. If you've got that in your business structure already, lots of fixed costs, it might be a bit rash to also have lots of debt, because debt is basically another great big fixed cost and one that you must pay, otherwise the business could be shut down. So if you're going to be more conservative about these things and worry about risk, you'd say high degree of operating leverage should not really go hand in hand with lots of financial leverage, because there's just too much risk in the system. Okay, so we'll move on to the next area, which is working capital. Now, I mentioned before, working capital has a direct link to cash, and we can calculate the cash conversion cycle. We can also look at various efficiency or day-related ratios. I guess at this stage, I want us to see that as less of a number crunching, formula learning approach, and more of understanding why this is crucial to a company, because cash and the flow of cash is the lifeblood of a company, isn't it? And if that flow stops or becomes too slow, then the company could fail. And it could just be due to the management of working capital. So your receivables, your customers who are taking a while to pay you, the money's in their bank account, not yours. Paying your suppliers, your payables. In that case, if you can slow that down, then the money's in your bank account, not theirs. And inventory. Inventory is a big investment. And if you've got a warehouse full of stuff, you could see the value of that stuff as being not cash in your bank account. So if you double your inventory level, you double the size of your warehouse, it's got to be funded from somewhere. So it all links directly through to the bank situation. So we're going to use this example as a good, honest test of whether you can do this. So once again, I really, really encourage you to just give it a go yourself. Obviously, I'm going to go through the solution, but give it a go yourself and try and work out the cash conversion cycle, also known as the net operating cycle, also known as the working capital cycle. Once again, it's those accountants having three names for one same thing. So we're using a well-known UK, well-known if you're in the UK, retailer of groceries and stuff like that, Tesco's. So we've got the year-end 2023 financial statements, selected figures from there. And what would be really good is if you could try and work out Tesco's cash conversion cycle, which is days sales outstanding plus days inventory on hand less days payable outstanding. Okay, and when you're ready, I will go through the solutions. Okay, so what I'd like to do before diving into the numbers is to just remember what it is we're trying to do here. So let's focus in on the days sales outstanding just for now, because I know that this gets presented in various ways around the curriculum. So this is how I see it. Days sale outstanding. It's just the number of days on average we're waiting for our customers to pay us. And I think it doesn't get much simpler than that as a concept, how long we're waiting for our customers to pay us. So we take how much we're waiting for them. Now, ideally, that should be an average, shouldn't it? Start and year end added together, divided by 2. But hey, we've only got year end figures here, so we'll just run with those. So we take the figure from the balance sheet, which is a snapshot point in time, and then we take the year's worth of activity from the P&L, 65,762. So we're just saying what proportion of a year's worth of revenue is that. So in days, multiply in the number of days in a year, and that tells us, to one decimal place, 7.3 days. So that is the average wait for a customer to pay Tesco. It's not very long, is it? But that's what you'd expect, because most people are paying in something that's very close to cash. When we pay on credit cards or debit cards or zap our phones or whatever, it's basically as long as it takes Visa or MasterCard to settle with Tesco's, which is a matter of days. So that's a reasonable figure, relatively low. So I always think that's a really good number to look at and just think about it in terms of time. But obviously you could work out your receivables turnover, which uses the same information, but just phrases the information a different way. So it takes your year's worth of revenue and divides it by your outstanding year-end receivables figure, and that gives you 50 times. Now I'll share a little secret with you. To me, that's never made a lot of sense conceptually. What does it mean? We can fit our cycle of making a sale and receiving the money 50 times into a year. That's kind of a backwards way of just saying it's taking 7.3 days for the money to come in. And I just think the days one's easier. But sometimes you'll see it presented that the days sales outstanding is, and I have to even stop and think about this, is the revenue divided by the receivables turnover, i.e. 50. And my problem with that is well, for a start, it's going two sides around a triangle, but also it just obscures the logic, which is at a point in time, the 7.3 days worth of revenue that we're waiting for our customers to pay us. But of course, they are both totally valid ways of getting to the right answer. It's just you might see both presented throughout the curriculum. Okay, so that allows us to then say, right, what is our days sales outstanding? As we've seen, 7.3 days. On average, how long is the inventory hanging around? Well, some of it is milk and butter and things like that. But like a lot of these big retailers, they've probably also got random things like trampolines and whatever. And obviously, dishwasher tablets. So days inventory on hand. Now we will be taking the cost of sales, which we had to work out there. And that's basically our estimation of a year's worth of inventory, and then what's outstanding at the year end. So there's just under 15 days worth of inventory that's sitting there at any point in time when you close the shop on whatever their year end date is and go, right, let's do a stock take. The purchases should really be focused on purchases rather than cost of sales, but we've only got the information for cost of sales, and that's fine as an approximation. Okay, so this is telling us an interesting story, which is that customers are taking just over 7 days to pay, or the credit card companies are, payments suppliers, whoever they may be. Then you've got inventory that's hanging around for just under 15 days, but this big retailer is taking the best part of 60 days to pay its suppliers, so the farmers, the producers of milk, whatever that may be. So the working capital cycle is that rare beast of a negative working capital cycle, which means that Tesco's operations net provide cash. So if it expanded, it would end up with more money in its bank account, which is unusual. Normally it works the other way around. And that's interesting when you look at, certainly in the UK, and I'm sure it's the same in a lot of parts of the world. Apologies for my UK focus here, but I remember sort of 15, 20 years ago, suddenly all of our supermarkets started offering financial services. Tesco, Sainsbury's, Marks and Spencer's, whatever, banks. And it's because they're just generating so much cash. What a brilliant business model then. They can start lending us money to spend more money at their shops or provide us insurance and all the rest of it. Anyway, very interesting. If you can find a negative working capital, it means you are generating cash, where most businesses have to fund working capital. Okay, so that's why it's important for us to understand it, because of the link with cash use and generation, which is something that pops up on our next slide. So where do businesses get their capital from and where does it go? Okay, so a lot of this I think you're probably familiar with. Why we're doing it here, because we're moving down that list of the 5 bullet points where we started off with revenue, we moved down to the operating profit, we then switched to think about working capital, and now we're still thinking about basically the balance sheet and the investing side of things. So we can see the sources of capital, cash flow from operations, especially if like a retailer, most of them, negative working capital. We can borrow more money, we can issue more shares, we can sell assets, all of those things generating capital for us. And then on the right hand side, of course, all the things that require capital, require cash. Okay, so we've got a big long list. I'm not going to go through everything there. You can see them on the slide. But of course, it's important for an analyst to think about how this is going to balance itself. So if there's lots of projected stuff on the right-hand side of that list, there's going to have to be plenty of stuff on the left-hand side of the list to support it. Otherwise, the company is going to run out of cash. So moving on into thinking about capital structure, then moving towards the end of our session on this particular module, we've got a few key measures that we need to understand. And now this is bringing in our understanding of the financing of the business as well. So we met the degree of operating leverage. We now meet its partner in crime, the degree of financial leverage, and how we don't really want both of these to be big numbers because it's just bringing in too much risk. So degree of financial leverage, we're not working it out from first principles. That is not what we do in this module. So if you've seen any other formulae elsewhere that ask you to say what it should be, that's not what we're doing here. Here we're observing what it is and what the relationship does. So we're saying what it does for us is it shows the change in the bottom line, the net income, profit after tax or earnings, relative to the one that we looked at last time, which is the percentage change in operating income. So it's just building in that extra layer of volatility. So lots of debt means that you're going to have a high level of financial leverage. Then also measures that look at the returns. And I think it's quite useful to compare and contrast these. Returns, we've always met 2 different ways of working out returns. One is looking at all providers of finance. So we call that the unlevered return. We are floating above the financing decision. The so-called levered return is when you go after the financing decision. So if we look at the levered return first, that means only shareholders. So only shareholders are looking at the return that they get after interest has been paid. So it's only looking at their input of finance. Whereas the unlevered return says, I don't care how the business has been funded. I'm going to take my net operating profit. I'm going to try and do it after tax. So we're going to have to do a little sort of operating profit after tax or adjusted for tax. And then let's compare that to all of the invested capital, so all of the operating assets. Now, we do operating assets, which means any cash short-term investments isn't meant to be in that figure. That's detail. But anyway, we've got our net operating profit, which is going to be put after tax, which just means you have to basically take the tax slice off, and we divide it by all of our assets, operating assets, but we exclude things that aren't really used in operations, so cash and investments. So we say that the business is generating an economic profit if that ratio exceeds the WACC, because then the business is putting in more than its providers of finance require out. Whereas levered returns, we're doing it just for the shareholders. Okay, so that would be different for different capital structures, wouldn't it? That's the point. So we meet the good old return on equity, DuPont, and it's one of those things I would test yourself going in to the exam. Can you break down the return on equity every which way? And just check that you can from a blank piece of paper. So it is the profit after tax divided by the equity, isn't it? Net income over net assets. But of course, we can break that down into the three-way net margin, asset turnover, equity multiplier. And then we can even break the net margin down even further. Now, I'm saying this because I know you've seen it before. So somewhere you will have already met this. So this is just reminding you your net margin can be got from these three things multiplied together, which is the operating margin we've met before. Interest burden, strangely named, isn't it? Because if the interest burden is 1, which is as high as it can get, it means you have no interest. If the tax burden is 1, which is as high as it can get, it means you have no tax. Okay, so your operating, if we just break that one down, your operating margin is your operating profit over your sales or your revenue, and your next two linking, so you want to get to your net income, don't you, which is right at the bottom of your P&L. So it's your net income over your profit before tax, and then you put your profit before tax over your operating profit. So interest burden, as I say, if it was 1, then your profit before tax would be the same as your operating profit. As it drops below 1, it means you've got more interest. Net income over profit before tax, again, if they were the same, it means you're paying no tax. So tax burden of 1 is as high as it can get, and that means you're paying no tax. As it drops below 1, it means you're paying more tax. Okay, so that was hopefully just a reminder. And if you're thinking, no, I haven't quite got that, then just go back and double check that, or indeed test yourself on this example here. So once again, I'll go through the numbers shortly, but I'll assume that you give yourself a chance to work it out before I run through it. Okay, so what we've done in this example is what they might do in the exam, just throw in some things that you don't actually need. So what's your estimated return on equity? So what have we got? We need to use our DuPont breakdown in as much detail as we can. So the first 3 are giving us our net profit margin going through operating profit margin times interest burden times tax burden. So those together end up giving us our operating profit margin, our net profit margin. Then we move across and say asset turnover. Yep, got that one. And then we take our, comes with various names, financial leverage multiplier or equity multiplier. So there are 2 things floating around that are of no interest to us, but that does happen. And if I were writing exam questions, which I do, but not for this exam, I would do that because, you know, the odd little thing just to confuse people. But if you know what you're looking for, you almost don't even see the unnecessary stuff because you go, nope, I know what I need, go and find it and find the answer. So 16.2% would be your estimated return on equity. And that's it. That is the end of this particular module. And I hope you'll agree it's it's bringing together things that all have already existed, are probably already in your awareness, especially if you've covered the rest of the curriculum. If not yet, everything that is here will be seen somewhere else. So hopefully, whilst there are a lot of words in the module, I do appreciate that, it can be distilled down to basically mostly everything that you've seen before. Okay, so hopefully that was useful and has given you a bit of exam focus on this particular module.